Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about two data visualization and analysis companies, Salesforce.com, client relationship, CRM, ticker symbol CRM, and then the other one is Alterix, ticker symbol AYX. So I'm going to be the host asking the questions. I'm going to be asking, and then Fabio, the other host, is going to have all the wonderful answers. So without further ado, what are we looking at here today? And to start, let's start with Salesforce.
I was about to ask you.
What is Salesforce? Who are Salesforce's customers and what does the business sell? What does the business do here?
So Salesforce.com is the leader in CRM, which is customer relationships management, right?
Which is what?
Everything to do with managing the relationships between the business and the customer. So
nice.
If I said everything, that's because there's a lot, okay? And this company is absolutely massive, and their product or platform or a group of products are very extensive, very vast, and ever growing. So if to simply pinpoint what they do is going to be very difficult, but I can kind of draw broad brushstrokes and kind of explain what it is that they do in that sense. Okay, so first, as always, I think we should take a look at the price movement.
Nice. Capital Mindset standard.
I'll say right now, I did hold a position in CRM. I had sold, and I actually got kind of lucky in my selling of CRM. But I sold above $300 a share. But I may or may not decide to add back in. And I'll kind of go over why I really bought it. It was more of a trade. So very few instances do I buy something not to invest in, but to trade. And the trade, it was a swing trade I did. And I bought it around the collapse because of Slack, and there was a lot of weakness in the stock, and I'll actually showcase like my thought process behind it.
So what is a swing trade here, just for some context behind what you decided to employ in this instance?
So swing trade is still a short-term thing, but it's not a long-term investment. So it's not something like 2 to 3 years. It's kind of like within 1 year. I kind of define that, and it's longer than a day trade. And a day trade being within 1 day, of course, pretty easy to understand. So what happened was they were acquiring Slack, and then there was some weakness in the stock price, and then it kind of collapsed. And then based on my analysis of the situation at the moment, it was oversold. And so I purchased here with the intention that actually with the momentum of the rest of the market and considering where they're situated, I could do a decent swing trade. But it was reliant on the momentum. So it was separate from fundamentals. Let's just be clear. And the fundamentals can be actually, we'll take a look at them. They're quite strong, but it doesn't necessarily mean it's value or it's a good, strong buy per se. But we'll discuss that. So I basically, I got kind of like, I didn't sell at 307. I think my final sale price was about 305. And the way I did it was I actually sold calls. I sold covered calls on my position. So I generated income on top of that at a strike price of about 305. And then it's sure for a momentary time, I was like, oh, I could have sold 307. But to kind of explain that, you're basically fighting over pennies at that point. I thought, based on my analysis, that the stock price would hit around 300-ish a share. And then I would be comfortable with selling at that point based on my buy price. And I don't know if for this one I'll put the trade in, but I might put the trade in. So you might see it coming up on the screen now, or you may not, but it just depends on whether or not I'm lazy or not about it. But the thought process there was simply that. But Salesforce as a company is a behemoth. That was a little bit of tidbit so you understand where I'm coming from going forward. Looking at this, I still actually hold a very small position. So I think there's, and when I say very small, it's very small. It's like 20 shares. So I can't, those were the shares that remained after the execution of the calls. So because you have to have 100 shares per each call that I sold. And at the time, there were 20 left over. So that's why I still have 20. And I just, I leave it as like to just look at the position. And if it comes down again, and if I do the same analysis again, and it's oversold, I may do the same thing again. It just depends, because it depended on a lot of factors. So a lot of it was the market as a whole was rising. This type of entity was, it should have favorable momentum. It was just basically coming down because of the sentiment at the time. And then I made my little trade. Anyway.
Okay. So going back to Salesforce.com itself again for a quick second, where my mind immediately jumps to this specific business itself is it has to employ almost an acquisition-based strategy of sorts to acquire these different businesses that exist as client relationship management type businesses in order to become the behemoth that it is now. My other question is too, what are some notable products that Salesforce currently has? And then also, are there any competitors that are currently overstepping or are crossing the moat that Salesforce is trying to build?
So we'll actually talk about one of them, Alteryx, but if we want to talk about their product like Tableau, which is actually in the data analysis portion, or more, to be more accurate, data visualization. That's kind of like what a lot of people point to. It's some of the things they've been acquiring. Also Slack, like I've been just mentioning. This is actually caused by the Slack acquisition, and Salesforce.
And just to stop for just a quick second, Slack is the business equivalent of Discord, basically, correct?
Yeah.
Okay. Cool.
Yeah.
And please continue.
Or Microsoft Teams is another comparison. Actually, it's a fair comparison. So Salesforce, you're right, has been pursuing an acquisition strategy, right? And the benefits of an acquisition strategy is you can buy something that's already kind of working, but you know, the drawback is you may be overpaying. So give and take, right? And they may be paying for that with some shares or just cash on the balance sheet. So we will take a look at that. But yeah, basically between the two that we're comparing today, this is definitely Goliath. And we'll talk about the other one after we're done with Salesforce. But this is Goliath. So before we go on, let's actually go to the model and actually see what's going on. So I already have it plugged in here. And we see that the analysts have it as a strong buy with a price target of 28%. So I personally, I can see where some might think it depends on what their models are saying about momentum, et cetera, stuff like that. But we'll see it based on the fundamentals. Let's plug in standard 10%. Okay. So basically, if they do not grow from here, very overvalued, very overvalued. If they don't grow, but they're probably going to grow. So let's assume a middle ground of 24%. Okay. Boom. There you have it. 10% rate of return right here. That's where you're at. Market average rate of return. All right. And let's assume we assume margin of safety. All right. Right there. Boom. Gone.
Quick question. Let's say is 24% growth in cash flows. Is that a unrealistic assumption to make given the industry that this is in? Or like the question that I'm basically trying to ask is, can we assume higher growth rates and cash flows for like software, client relationship, et cetera, type businesses in this instance?
It has nothing to do with the business industry. It has everything to do with the business.
Business.
So
okay,
like how good is their product?
Specific. Okay.
Yeah. Revolutionary speaking, whatever. So I do think, look at this terrible dilution that's going on. So if I say we're going to dilute you by about 7% per year, absolutely terrible performance we're going to experience. But let's see if we can get it at 50%. All right. That's a little excessive. Let's go to 40. All right. So wow, 40% growth in cash flows is pretty extreme. Let's be real. So I wouldn't even be able to get that. Actually, at the prices I was buying, I was able to assume that. And of course, that's the remaining shares I have. The remaining 20 shares I have is actually close. It's lower than that by price. It's like, I think it was 220, 216, something like that. I know that the final return was like 40% when I executed the calls, or when the calls were executed for me, because I had no choice. Whoever bought them is a sucker, by the way. But it's neither here or there. So 40%, I'd have to assume that, and it's still overvalued. Let's see 45%. All right, so that 5% delta actually makes the difference. So let's see 42. Yep, and then 41. So we're just about at a 41% assumption, and assuming a dilution of 7%.
And
so I actually like
50% margin of safety in this instance too, or a 15% required rate of return.
So I'll say I like these odds over here. I don't like these odds. I don't think that getting 41, and let's see 41.5. Yeah, 41.5. I don't know if that's really doable by the business for 10 years in a row. I don't think so. So on
My
fundamentals.
question, have they announced a buyback program of any sort, or is there a indicator that maybe this dilution might occur into the future at this specific rate right now? Because 7% dilution.
I would not want them to be buying back shares. I would actually say that as a red flag.
Interesting. And why is that in this instance then?
Let's think about.
Does that kind of go into the
I'm going to put you on the spot, Austin.
Yeah.
Why would a buyback be bad?
If the price is more than what management has determined the present value of cash flows are in this instance?
Or what we have? What if their models are wrong? What if their models are absolutely ridiculous, right? Yeah, we have to be independent thinkers sometimes. And you're the investor. You don't have to give them your money. You do not have to buy their shares, right? You don't have to do that. No one's forcing you to do it. So what are you comfortable with? So if you think they're undervalued and you see them buying back shares, well, then you should think it's a good thing because you already thought that the shares were undervalued. Now, if you think the shares are overvalued, and they're buying back shares, they're just burning your money. So that's where I say, so you opened up a can of worms, my friend, because
I did. I was the agent of chaos.
Oh, yes. So here's the little tidbit that I explored in a previous video. And I think it was the one about the cigarette companies. The debate that exists about dividends and buybacks and which one's better, which one's not better, it's rather mute because I when I hear both sides kind of explain, they don't fully explain the full picture. So it's not that one is bad or one is better. Neither of them are objectively better. And I'll actually discuss that now. So the answer is, again, it depends. Okay. So buybacks are good in the sense that if you are a high net worth individual, right, you may avoid some taxes on capital gains. However, you are making the assumption that the company is doing it at favorable prices. Now, who determines that? Well, that's a little more difficult now. So if we are operating under the assumption, right, that the buybacks are being done at favorable prices when it is actually undervalued, that would then, therefore, in theory, be accretive to the remaining shareholders, right? However, if we can determine to some objective fact that the buybacks are being done at unfavorable prices, then you are literally grabbing money and burning it, right? And in fact, it would be superior to grab that money and give it to shareholders. Now, the question then becomes, what are dividends always good, right? Well, no, that's also not the case. Simply saying that dividends are always the better answer is also not the case. For example, if the share price is very undervalued at the present moment, it may actually be more tax advantageous to buy back the shares, right? That is also correct. Also, you have to consider, well, what is the business doing with that money? So let's say they're returning on their invested capital 15%. So you have to ask yourself, can I reliably generate 15% per year? If the answer is yes, then you personally should want a dividend or a buyback, right? You should want the dividend because you're going to be getting cash and redeploying it elsewhere. Okay. Mm-hmm. If you don't think so, if you don't think you can get 15% rate of return and you see that the business is generating a 15% compounded return in the cash that they keep, you don't want them to give you a dividend. You will probably want them to keep their money and use it for the reinvestment into the business. Okay. So everything's very nuanced. It entirely depends on the circumstances. You throw me one company, I'll say they should probably be paying a dividend. You throw me another one, my answer will completely change. Right. And and people who draw broad brushstrokes onto dividends are good, buybacks bad, or buybacks good, dividends bad, are wrong objectively, because I will always find a scenario where they are wrong. I will find a scenario where they are right, and I will find a scenario where they are wrong. So if you hold that
again,
if you hold that as an absolute truth, you are objectively wrong, because I can at least find one scenario in which we're wrong. And then so if you hold the truth to be it depends, you're always going to be right, because it always is true that it depends, right? Everything is usually true that it depends. And if the world is not simply put into like a little box that everything just fits inside the box, it's more nuanced. So the point being said, that I don't want them to be doing buybacks. It would be a very poor use of capital. If they want to return cash to me, give me a dividend. For this company, give me a dividend, right? And I'm looking here. Yeah, give me a dividend. I don't want you to hold too much of my cash. I don't want you to do buybacks. I do not want you to do buybacks. If you do buybacks, you're grabbing my capital and you're burning it. Simply put, you're burning my money. So in fact, if you wanted me to actually like this, dilute me, please. Yeah. So if I'm a really old investor, I've been invested in this business. Like, let's say we change the roles up a bit. I'm an old investor. I've been invested in this business for like 10 years. Let's just say hypothetically. And I'm in this for the really long term. These are the moments where I want management to dilute, get cheap capital, and generate higher returns than this capital that they got. And I'll make the decision whether or not I sell or not, right? But let's say I decide not to for whatever reason. Sometimes it could be from I just don't care, right? That could be actually a valid reason. People forget. I'm an investor for the long term. I just don't care about it right now. I'm just going to leave it. I would want the management to be very intelligent and then get the lowest cost of capital to fund the future growth of the business. Well, guess what? If the stock is expensive, that's probably the lowest cost of capital. Probably want that dilution. And they're doing it.
Yeah.
Right? The management's not stupid. That's what I'm saying. Good on the management. They're not stupid. Now, that changes my perspective on whether or not I want to invest in it. Now, these analysts, again, they could have different models. There's so many different ways to model the performance of a stock going forward. And I just described one of them at the very beginning of the video, that my intention behind this was not as an investment. It was actually a swing trade. Now, I'm not selling the last 20 because I just couldn't care. But the biggest portion of the position I executed, fairly well in my opinion. And I don't know at this price whether or not I'd have to relook at everything and probably maybe come to some agreement, or I need to know how they did that, right? I'm guessing they did it based on momentum models, not so much on fundamentals, because I'm looking here at the fundamentals. There's very little reason. And so basically I have to trust that the sentiment of the rest of the market will maintain itself, which is very risky. So that, remember, like in finance and investing, there's so many different strategies we can employ. If they're using a momentum model strategy, they're going to be relying on the fact that the rest of the market's kind of, we're kind of moving up. And then there's also no, I'm not going to get into that. I'm not going to get into
that.
Well,
actually,
yeah.
Do you have any closing thoughts on Salesforce before we move to Alteryx?
I think that's pretty much it. I'm pretty much concluding they're overvalued for what they are right now. It depends on your strategy. On a fundamental basis, they're overvalued. If you're doing a momentum-based strategy, maybe not. You have to do, there's a lot of different techniques, a lot of different things you got to take into account. Okay. So trading different from investing, separate the two. Remember my VIE investment that was by kind of more or less pure accident. That's a trade. I'm very explicit in the video when I say, and just so happens that the video, when we released it, the next day that we made the video, it was potentially the bottom of those VIEs. But again, there's strategies that you employ for a trade versus an investment. Okay. Ending, we're done. Alteryx. Okay. So Alteryx. And by the way, if you have any questions on anything I said a lot and I didn't go deep enough on anything, if I'm being honest. A lot of those could be their own videos. If you want a video on that, even if it's just one of you, comment that down below and we'll set up a video.
Make the video.
That's what we want our channel to be over the long term, kind of just being a free source of education. All right. So Alteryx. Alteryx, this is another data visualization, data prep. Basically think of big data growing. So a lot of companies that yep, you have a question. I know the prayer hands.
Yes. First question. You know me too well, but first question, what distinguishes Alteryx from Salesforce? Just jumping right into it. Because
very different in the broad scope, but very specifically, Alteryx competes with Tableau. Very different in the broad stroke. Specifically, Tableau is where they compete. Okay. So before anyone thinks that Alteryx is mini Salesforce, no, they are not.
Okay.
Salesforce, very big, lots of things that they sell under one umbrella. Alteryx, very specified, very specific in what they're attacking. Okay. So Alteryx, I know of a lot of large clients that they're taking from Tableau. And from my experience of talking to people in the industry who use the platform, they prefer Alteryx over Tableau, because Alteryx is like a one-stop shop for data analytics. It allows you to do the data prep, the data cleaning, the data sorting, visualizations. Tableau is pretty much under the two categories of data prep and visualization. And I've used both at this point. I'll say Alteryx is a much more low code platform than Tableau, and Tableau, that's being generous because Tableau is really not high code.
Yeah, it's not
either.
It's not a lot of code. It's just maybe like a function here and there,
But
it's about
yeah,
it.
it's kind of like if you know Excel, you'll know Tableau, and Tableau walks you through it too, the functions. But
it does.
Alteryx is even a little bit more low code, which is pretty interesting.
Okay. So here then, how is Alteryx, other than low code, how is Alteryx distinguishing itself on the data analytics forefront?
Oh, like I just said, they actually they're like a one-stop shop. They do the full process of data processing.
Cool.
So and we see like the size of the business. So we saw that CRM is about $250 billion. Alteryx is about 4.2. So drastic size difference. And we see, I know that they're actually changing management changing, the founder's leaving, and then a new guy comes in. So Mark Benioff is still at Salesforce, and he's pretty much the face of Salesforce, you could say. So Alteryx is losing their face, and that could be a good or bad thing. But we'll kind of take a look. So these two, again, they're software businesses, and we'll look at the ratios because I know we forgot because we were going into other things. But the ratios of this business, we'll go over that last. Go there. But the buy rating of analysts, look at this right here. Analysts say it's buy 62%.
Are they okay? So taking I don't know exactly their strategy here, but the question that I have to ask now is typically Alteryx, the businesses like Alteryx in the respective industry, are they trading at typically higher prices?
Yes, but analysts can come to their price targets in a variety of different ways based on fundamentals. They'll say everything's fundamentals. So they'll say, oh, the fundamentals are good, but the fundamentals may not be good. And they still might say that. And then people who don't know how they exactly do their models will think that they're doing it off of fundamentals. But there's a bunch of different ways that they can do this. Like again, the momentum, they can measure momentum and see, okay, is the momentum favorable? And at the moment, Alteryx may have favorable momentum if the market maintains itself, but then, you're bringing in a bunch of different assumptions. So let's take a look at the fundamentals. Let's do a 10%, right? And what did we say for CRM? Did we get up? Yeah, we tried 15%. So, all right, so let's take it to 10% and buybacks. Let's sure thing. Let's assume that dilution. Let's assume -3%. Growth rates. So let's do the average of 46%.
Ooh.
All right, boom,
wow.
Done. All right, so let's see if we get it to 15%. Boom, done. If they can do what they've done in the past 5 years, you're good to go. However, can they do that? Is that slowing down? Let's take a look.
Interesting.
Okay. So cash flows are in a continual uptrend. Good. I like it. So now the trend line growth would suggest that they're going to keep growing from here. Let's see that revenue growth. All right. So keep growing from here. That's slowing down, but still. So if they can accelerate that going forward to get a bunch of new clients, which may happen if capital investment comes back into corporations around the world in terms of data analytics, Alteryx may enjoy the benefits. And remember, they're small enough that it may actually move the needle. They're small enough. They're a very small company. So we have to keep in mind. Now, I think the long-term cash flow amount, I think I am assuming, no, they are actually cash flow positive. So I don't have to make that assumption. So if they grow at the average of the past 5 years, this would be a buy. Now, let's keep that in the middle assumption. And I think for the uncertainty that we may have, we should imply that in the discount rate. Boom, there we go. So what did I do for everyone who's kind of new? What I've done is I've increased my uncertainty assumptions.
So margin of safety. So basically what Fabio is saying is that he now has a comfortable cushion by which if he's proven wrong, he could still come out on top if the price that was returned to him here was favorable in this instance. So try 52. See what that.
Well, it changes to 52 because I want to go from low to high.
Oh, yeah.
So I'm going to go back to 55.
Yeah.
Try to do in like some intervals. All right. And now, so I'm weighting it at evenly. So based on these assumptions, it's saying it's not worth the risk. The model is telling me this is not worth the risk. It's saying allocate negative 1% of your portfolio to the position.
Mhm.
Now, if you want to say, I want to lean on assumptions 3 through 5 a little bit more, it's actually getting right up to the point where it's saying it may be worth the risk. But again, you do have to assume, I think let's see what we have to assume based on current price. So we have to get to around 62. So let's try 50. Nope, we have to assume 52. 53. 53.
There you go.
So
Yeah.
about 53% growth rate. If you want to assume that 53 and above, and you're very confident on that, it says based on the risks, all these assumptions, you see that it's such a small percentage of the portfolio that we would allocate, or that, the model is suggesting, because it's not to lean on it. It's not to say that, oh, I just follow the model. No. It's I'm leaning on it. I'm saying, okay, so it's taking into account a bunch of different factors. And we can see here, the risk of bankruptcy is not there. So my model is telling me that based on the Altman Z-score and my custom calculation, that it's not at risk of bankruptcy. So Altman Z-score 3.75 and no risk of bankruptcy within the next couple of years. So we'll take a look at the key ratios, and then we'll come back to these growth rates, and we'll talk about whether or not we agree. Remember, I'm discounting it at 20%. I think that may be appropriate because I don't know. I don't have that much of an insight into like the big data business. So I probably want that higher margin of safety, but maybe you think I'm being too crazy and 15 is more appropriate. And which in that case, I think we can assume the 46% growth, and we can probably assume slightly lower growth rate. So let's actually bring all these down. But if we keep them as the way it is, the model's now saying, okay, see, like, because my assumptions have been lowered, my expectations, my expectations on what I want to return has been lowered. The model is therefore saying, okay, increase that position to 2%, right? So, and again, I'm still doing that dilution, but watch how happens if I say no dilution going forward. Well, then the model's saying, okay,
wow.
now you can put in close to 3.4%, right?
Mhm.
And then, but it depends. What if you think 25 is not even probable? I'm being too crazy by even assuming that, and I'm allocating a weighting of 10% to those scenarios, right? You don't even think those are possible. Maybe you think I'm absolutely insane. I'm saying there's a 10% chance that you get 35 or 25% growth rate around there, right? That's what's going on, and that's actually what's dragging us down, right? What's propelling us forward is the 46 through 60, and then the model is running some math calculations in the background, and based off of the bankruptcy risk profile and some of the things going forward about these assumptions to the risks, kind of say that. But you may say like, okay, that flagpole, I don't care, I'll put 10%. Or you say it's not for me, I'll put 2%, 1%. It's just a flagpole. It's not something to like take as religion. Okay, so key ratios. Let's take a look at what's going on. I don't care about the activity ratios, so we're going to ignore those. All right, so
it's a pretty good cash ratio.
Everything's beautiful across the board. Let's run through this because we don't want to make this a 2-hour long video. So pretty good across the board. You can pause here, you can see what's going on here. Everything's looks pretty solid. Earnings quality could be getting better, but we'll see. Probably going forward, it might get better. So let's take a look at Salesforce, because we didn't show the people. We must show the people what they want.
We got to show the people, Fabio.
All right. So same thing here. You can pause and kind of look through. We don't care about the activity ratios because the activity ratios are for inventory heavy businesses. This is a software business. Also phenomenal. Very good. Indicative of software. These are 2 software companies, high gross margins, very high earnings quality. Phenomenal. Love it. Everything's pretty good. Looks pretty solid. All right. So I think with that, let's get to the final points. So we have CRM and we have Alterix. So Austin, guns to your head, you must decide. Are the analysts right? Are you buying? Or are you thinking about buying?
I still am unsure if I would be willing to buy, as most of you should probably know by now. I typically like to invest in boring businesses. So in this instance, big mining players, grocery stores, stuff like that. So I still don't know entirely if this would make it onto my portfolio. However, I'm not exactly ruling it out. I'll probably just continue to do more research and just see what I come up with. What about yourself, Fabio? What do you think?
For me, I still own CRM, the 20 shares I have, which is
Mhm.
now nothing. And I did not invest in it for the fundamentals. I actually would agree with my model that I don't think based on, and by the way, you might actually be saying, before I forgot to say this might be too harsh. Let's just say no for now, because that was the acquisitions. You might say that, or you might have that opinion. And in that case, you may make a different kind of case, because but still at the growth rate that they've averaged out, you have to assume acceleration. And I'm not sure if I'm comfortable with assuming that kind of acceleration, because
Yeah.
that's assuming, right? I
Mhm.
do think they will grow, because the business that they're in is a growing sector, but I'm not sure if I'm comfortable too much with assuming too much acceleration. Let's see if we 30% before I cut off here. So I bought it for a swing trade, and that's pretty much it, for different reasons, separating fundamentals. So yeah, and on those kinds of videos, I don't think I would be comfortable with making them, because it'd be pretty irresponsible if, for example, because with trading, you have to be constantly following, if you know what I mean, Austin.
Yes.
Like,
Yeah.
if we ever did a video about trading, it would be highly, highly, highly irresponsible of me, because it would have to be in a way where the individuals were constantly following. But even then, I'm not a financial advisor. I shouldn't be giving you any advice. So,
Yeah.
but it would be very, 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 very irresponsible of me to put out a video about a trade I'm making, a swing trade, and then not have constant follow-ups about it. So, and I don't have the time personally for it. So, as an investment, the investing videos are a little bit different, because you can have a thesis and it can take out like 2 to 3 years to play out. So for Salesforce, I don't think the fundamentals are quite there to make it compelling. I actually agree with management. Yes, dilute me, or dilute it. That's probably the lowest cost of capital available to you. For those creators or content creators who believe that a stock won't dilute you when it no longer needs to, do you see why I cringe?
Yes, I
Do
do.
you see why I cringe? Because Salesforce, I'm pretty sure, doesn't need the cash. I'm pretty sure they don't need the cash, and they're going to dilute you, because
Yeah.
that is indicative of the management not being completely incompetent, and knows that they need to lower the cost of capital. Okay. So when the shares are overvalued, they're going to do it. All right. And then for Alterix, I have a small, tiny position. I believe Alterix is more on the lines of my speculative pile. It's I checked before this video. It's about 0.5% of my portfolio, my entire portfolio. So the strategy with this one, it's kind of just a play on big data, but it will never make it to like a large position of my portfolio. It's kind of like more of a watching it. And then if Alteryx, maybe it lives up to somewhat of its long-term potential, I'll still kind of feel it within the portfolio, but it's not a high conviction play at all. It's a very, very, very low conviction, but it's still in there. It's made it in there because I thought the business was compelling enough.
Okay.
Nowhere near a core position is what I'm trying to say. And if it goes bankrupt tomorrow, I literally will not feel it.
Okay. Yeah,
So
perfect.
that kind of ends it.
All right. Well, with that being said, we hope that you guys have enjoyed what you've seen here today. If you have, please be sure to comment in the comments below, critique us, agree with us, whatever you'd like. Please be sure to share the video.
We may
Yes.
have missed some things, because otherwise, these videos can't be too long. We may have missed or brushed over some things. If you want to add to the conversation, comment down below the criticism, or like
Exactly.
adding to our points, right? So
exactly.
go for it.
So with that being said, also visit our website at capitalmindset.org. Be sure to like and subscribe. We are your hosts, Austin and Fabio, and take care, guys. See you guys later.